Good evening, members. Good evening, ladies and gentlemen, and all those people joining us tonight. It's a very cold and miserable day in Melbourne, and I think mostly 12 degrees, maybe a few 13 degrees, but and congratulations to all those people who have turned up here tonight. It's great to have you along. Tonight we've got a couple of special speakers, but our first speaker is none other than the infamous Alan Clement. Now, Alan's been trading for over 30 years, and he's developed a passion and interest for systematic trading. But regularly, every 3 months, he does a market update whereby he looks at all the charts around the world and tries to figure out what's going on. So please make Alan very welcome. Thank you, Alan.
Thank you. Thank you very much for that ripple, and welcome to everyone online. It's good for you to be with us tonight. And this is the global markets technical outlook for coming up to at least the end of Q2 of 2024. Normal disclaimers apply. The normal disclaimers apply, meaning none of this is a recommendation to buy or sell any financial instrument. Please do your own homework or seek professional advice. I always like to start with a quote. This one comes from Charlie Munger, who left us recently at the ripe old age of 99, who says, show me the incentive and I will show you the outcome. And that's great advice for anything in the world, whether it's the actions of politicians or some decision your dumb mates made, or with the decisions you make in the trading world. It's all about incentives. So let's have a look firstly at the US stock market. And on the monthly chart of the S&P 500, we can see there on a log scale, this is a strong bull market. There's just no two ways about it. You can see it's broken once again into all-time highs. It's bang in the middle of the tram lines of the trend line there. And you know, the only way you would go short in this market is if you turn that chart upside down. So very strong. And as you'll see on the next slide, this is the weekly chart showing that we have broken through that psychologically important 5,000 number. You can see, just if you can just probably pick out a nice sort of rounded bottom on that correction there, maybe even the hint of a cup and handle as it broke up through that old high there, and then straight through 5,000. It came back, retested the 5,000 level. So that's given us confidence that level is holding there. Support is strong, demand is showing up around about that 5,000 level. Of course, with the market that's strong, you wouldn't be surprised to know that the Ichimoku chart is also looking very bullish at the moment. Both the price and the Chiku span, both above the cloud there, and the cloud support down around that 4,400, 4,600, which is a decent way south of where we are now. In fact, a good 100 points or so, 100 S&P points. So if the market does return to that point, we would expect we'd expect demand to show up in the cloud area, but we're clearly nowhere near that at the moment. So very bullish for the S&P 500. The question is, do the market internals back up that fact? So let's have a dig into what's going on behind the scenes. Looking at the market breadth first, this is the bullish percent index, which measures the percentage of stocks in the S&P 500 that are showing bullish patterns. And that is currently showing 58. Now, what's interesting is that you'll see that as the market's made highs each time in the last, let's call it 24 months, the peaks have all been around about that 80 level. What's happened recently with the last couple of highs is that we're seeing the peaks of the market breadth indicator just starting to fall slightly. And that just indicates we're starting to see a little bit divergence. This is certainly not a signal to sell the market. Certainly, if you're holding the market, I wouldn't be doing anything. You may not be wanting to buy at these levels, but you definitely don't want to be selling just on this evidence, because as you'll see back on the earlier part of the chart, these divergences can last a long time while the market continues to rise before it eventually breaks. So they're very, very inaccurate in terms of being timing tools. And if you look at another breadth indicator, this one's the stocks above their 200-day moving average across the whole of the NYSE. you can see that it's pretty much still showing us in a very sort of bullish phase. We're not seeing any signs of divergence on here, and 65% of stocks above their, or 2/3 of the market, let's say, above its 200-day moving average, is a reasonably bullish number still. Moving to the discretionary versus staples, so this can be a leading indicator of the market, and again, we're just starting to see the first signs of divergence coming in there as the staples start to outpace the discretionaries, and whilst the market is still going up, perhaps we're just starting to see the first signs that momentum is starting to slow. This chart looks at the ratio of the semiconductors index versus the S&P 500, and you can see this is very, very bullish. It's almost poking out the top right-hand corner of the chart there, and there's plenty of reasons why that's the case. Obviously, I mean, the main reason why the market has been going up so strongly in the last 12 months is the AI story. That's the big theme of this market at the moment. And that has been driven primarily by the big growth stocks, the big tech giants, the Magnificent Seven, as they're sometimes called. They're all going up as fast as they can, and they are hoovering up these chips as fast as they can, because these large AI models are very hungry in terms of what's called compute. And the way that they add more compute is by buying more hardware. And they just can't, the chip makers can't get them out the door fast enough. In fact, second-hand chips are going for 3 times what they originally cost. So there's no surprise that the semiconductors index is going gangbusters at the moment. And that, given that the growth stocks are a large portion of the S&P 500, is going to pull the whole market up, at least in the short term. Looking at the advanced decline line, we can see that's actually poked back through the old high, and now is showing it's created another all-time high, and you can see it's got that same rounded bottom that the market had on it. So no signs of divergence here. Again, it's saying that as the market's rising, there's more stocks going up than they are going down. So once again, that's a tick in the box for the bullish side of the market. And if we look at how the 3 main indexes in the US, it's a little bit hard to see on the screen in the room here, but the S&P and the NASDAQ have done about, well, let's call it between 13 and 15% so far this year, whereas we've got the Russell, which is the small caps, down around about 2 or 3% just for the year. So again, this just indicates a bit of divergence in the market. And the broader indexes, the NASDAQ and the S&P, are being carried up by those big growth stocks primarily. But the small incubator stocks, which is what we're seeing in the Russell 3000, are really just being overlooked at this point. And once again, the Russell can tend to be a leading indicator for the broader market. So that's just something to bear in mind as we go forward. Moving on to the yield curve. If you haven't come across the yield curve before, it basically measures the relative interest rates across bonds of different maturities. Very short-term bonds on the left, very long-term bonds on the right. And what's interesting about the yield curve is that it tends to indicate the amount of risk that's being carried in the stock market. If we look at what happened in 2000 and 2007, you can see the yield curve was very flat, or a little bit inverted, when it's further up on the right than it is on, further up on the left than it is on the right. And what's called the normal curve, where it's very low on the left and high on the right, is what we tend to see when bull markets are beginning or are developing, and that's a very low risk point in the market. So the question is, where are we now? Well, this is the shape of it at the moment. As you can see, it's massively inverted, and it has been for a good 12 to 18 months. The main reason for that is that the Federal Reserve are holding the cash rate high because inflation is so sticky at the moment. That's holding the short end of the curve up. Meanwhile, the long end of the curve at the right-hand side's hardly budged. Now, what this normally indicates is that there's a good chance of recessions on the horizon, because you know, capital is getting expensive, less borrowing is going to occur as a fact of that, and that'll slow down the economy. But if we look at what's really happening in the economy, there's no huge sign that there is a recession on the way. In fact, the New York Fed, they put the probability of recession in the next 12 months at no more than 50%. So it's effectively a coin flip that we'll get a recession in the US in the next 12 months or not. So make of that what you will. Either the yield curve is wrong. I mean, it's been right 8 out of the last 9 times, or there's something else going on that's not well understood at the moment. But on the sentiment indicators, this is the put-call ratio. Low put-call means the market's overheated. High put-call means the opposite. As you can see, we're not really in either of those extremes at the moment. If the put-call ratio was very low, below 0.55 on this chart, that would indicate the market's getting very overheated and it's likely getting to that inflection point at the top. But we're not seeing that yet. So again, this is another reason just to be quite happy that the market's in a bullish phase. We're certainly not seeing the volatility in the price charts that you would associate with the top. I mean, most of us here can probably remember what happened in 2007. It looks nothing like that at the moment. So again, this is steady as she goes, but just one to keep your eye on. The volatility index, or the VIX, is in much the same boat. It's very low at the moment, and what that indicates is there's very little demand for downside protection in the markets. So most institutional money managers, rather than sell their stocks when the market goes down, they'll buy protection in the form of puts or VIX futures, and that drives the value of the VIX higher. But as you can see, there's just no demand for those kinds of products at the moment. Therefore, the VIX is very low, indicating that there is not much fear around in the market. Everybody expects the market to keep on moving higher. Interesting little, I don't know what you would call it. It's not really, I suppose, it's an indicator, but this is the CNN actually produced this. It's a quantitative measure. They basically look at a number of different breadth measurements, the momentum in the market, sentiment indicators, and so on, and they put them together, and they come out with a number between 0 and 100, indicating whether the market is very bullish or very fearful. And as you can see at the moment, it's bang in the middle. So once again, that just indicates that there's no need for panic at the moment. But by the same token, you maybe just want to think twice about being a buyer at these levels. Another indicator that indicates much the same thing is the Bank of America's, what they call their sell side indicator. And this basically measures the allocations that balance funds have in equities. And as you can see, it's sitting there around about 55 at the moment. And the red and the green line there just indicate the extremes. So if we were to get up above 58, that would indicate that the market's starting to get overheated. We're obviously not there yet. So once again, no need for panic. On to the cycles, and this is the annual seasonality for the S&P 500. And as you can see there, it's not a great facsimile. I mean, January and February are typically supposed to be quite quiet months. We actually had quite a very bullish January and February. It does indicate a pullback in April, a little one. We actually got quite a big pullback in April. So the jury's out about whether we're following the cycle at the moment. The chart's up by the end, and so our chart's up. I think that's probably the best we can say on that one. But what's interesting is if you look at the monthly returns on the S&P 500, who would have picked that July as the month with the highest average return in the mean? Yeah, not me either. So that was a big surprise for me, and obviously that's us. We're coming into July next month. Obviously, the market's come quite a distance. I mean, it's done more than double its average return already this year. So whether we add another 2.3% in July would that would certainly be a surprise to me. But what it also means is maybe if the market's going to want to sell off at some point, maybe July is not the month it's going to do it, if that tends to be more bullish. And also, we've got a presidential election year. So we'll look at the election cycle. The so-called election year is where we are. We've got a sitting president who's rerunning for election. So that's the green line there, is what we should be measuring our cycle against. It does kind of indicate a little bit of a dip just in the March there. The dip in the actual market came a little bit later in April. So it could be that the market is just running behind the cycle. It's just a little bit late. Other than that, I think the shape of it is fairly good. You know, the S&P's been going up. The cycle is showing us pretty much going up all year after that pullback in March. So maybe this one's a little bit more on target for what we want. On the decade cycle, year 4, which we're in, 2024, is supposed to be a quiet year. We're certainly not having that at the moment. So this one seems a bit out of whack. And Calvert-Clark's decade pressure cycle charts, which uses an average of rates of change to come up with its values. You can see there it's 4 is one of the quieter, nevertheless positive years. And once again, that's not what we've seen this year. So we're a little bit out of cycle with the decade cycles. On to the Australian stock market, and on the monthly chart, you can see that we've pushed into all-time highs, and we are holding. So one question mark I had the last time I did one of these 3 months ago was, what was the breakout that we were seeing above 7,600 actually going to hold? Because as you can see from the chart, the XJO has a habit of reaching these levels and then mean reverting. But on this occasion, it is actually holding. In fact, it's come back and tested that level. Here it is on a weekly chart. You can see it came back down, just dipped briefly below that 7,600 level, and now it's returned and moved higher again. So, you know, it does, if it can hold up here and gather its breath, if you like, for a little while, then you would probably have to favor the upside rather than the downside for the XJO. And of course, it is quite bullish, so you would expect that it's showing a bullish Ishimoku chart, which is 7,200 to 7,300 is where the cloud currently sits. However, as bullish as it's not been all that good, relatively speaking. If we look at the US and some of the Asian indexes, you can see it's the Nikkei that's actually been doing the heavy lifting in our region, up around 15, 16% there. Then we've got the S&P, as we know, around about 13. Next, we've got the Nifty, the Indian Nifty, which comes in about 6%. Then the Hang Seng, which has sort of had a little bit of a move in the last couple of months, has overtaken the XJO, sitting around about 5%. And there's the ASX 200 coming in around about a measly 2% for the year. On the currencies and the US dollar index, well, it's that 103 level is the level still to watch. You can see the index shot up through that it's probably a couple of years back now, wasn't it? Yeah, 2022, I think. Then came rolling back down as the interest rates started to, or the expectation that the interest rates were going to start to come off came into view. But now with the inflation being sticky, there's no real consensus about whether rates are going to come down or whether they're going to stay more or less where they are. And that's what's causing this market just to drift sideways there, as you can see. So it's all going to hang on what happens with interest rates. There's no doubt about that. As soon as there's an expectation they're going to fall, this market will fall. If there's any sign that we might get one more rate rise, then we'll see another move higher and in this chart. But sideways and holding above 103, I guess, is the headline. And that sideways move on the US markets, also the US dollar markets, also feeding into what's happening with the Aussie dollar. It's pretty much gone sideways. It doesn't look very far back on the chart here, but that last peak above 70 cents, the last time we saw 70 US cents was actually almost 18 months ago. So that's a fair while ago. We've been stuck below that 70 level. It is managing to hold above that 62, 63. So that's the range it's in. And once again, it will depend who moves first on rates, whether it's the RBA or the Fed, as to what happens with the Aussie dollar. So I think everybody's just watching and waiting at the moment. The euro is pretty much in the same boat. It's just been going sideways. I guess after its near-death experience dipping below $1 there, it's managed to come back above that 105 level, and it's just holding in that area. So that's a positive sign. But you can also see at the same time it's stuck below that very long-term downtrend line or descending triangle line you can see there drawn on. So that's going to temper the upside. But sooner or later we'll have to get to a resolution one way or another on that chart. But the poor old Japanese yen, despite them raising their rates ever so slightly, has still been getting hammered, and it's now back at this support line of 0.0062 that goes all the way back as far back as 1990, would you believe? So that's a 35-year-old horizontal support line there, and we've now touched it once again. So that's significant. And if we did see the yen fall through that, well, that would be very, very interesting indeed. But there's a lot of momentum behind that downtrend. So it would be a brave man that stood up and betted against that. And on Bitcoin, who's hands up, who's holding Bitcoin? Nobody. Come on. You had a chance to buy it at 15K a couple of years ago, and you would have been 350% richer by now, no question. It's been a meteoric rise. It was only back in late 2022 when everybody was forecasting the end of crypto and the so-called crypto winter was upon us. And then have a look, just a hop, skip, and a jump, and it's back up over 70,000 US dollars. Who would have thunk it? But once again, this is almost the opposite of the yen, really. It's probably a brave man that would try and stand in the way and short this market, because certainly to my eye, this looks like a very bullish market, and the upside is probably the path of least resistance. And there's even people talking about 100K by the end of this year. So make of that what you will. Rounding off on the commodities, oil has kind of been in the doldrums, just drifting sideways, really, stuck between about the high 60s and the low 80s there. Depending on where you draw that green trend line in, you could make an argument that it's broken above it and it's maybe just finding support on the top side of it. So maybe just favoring the upside slightly more than the downside, but it'd be hard to argue it's anything other than sideways at the moment. On wheat, well, wheat continues to fall. There's some bumper crops coming out around the world, especially Australia and Russia. A lot of the supply chain issues have been sorted out since the start of the war in Ukraine. So that means the price of wheat is coming down. That's got to be good for inflation, given the amount of wheat and wheat products that there are used in the market. So 427 is the key support line there. It'd be very interesting to see what happens if and when it reaches that point. On iron ore, well, Chinese demand is slowing for the primary input of iron ore, and so that's causing the price to pretty much go nowhere. It had a brief flirtation with that 130 level, and it held up for about 8 or 9 weeks above that level, but then it slid back down, and you can see it's right back in the middle of the range again. There's kind of just a hint of a support line around about that 100 level. That's probably just a psychological line, but if it drops below 100, then you can see that 80 level would probably be back in play once again. And finishing off on the two superstars of the commodities world, copper, of course, had that massive breakout. This 3 months ago when we gave the last one of these, it was just sitting here on the edge of that symmetrical triangle formation. and then kaboom, it's gone up, shot through the top of that, shot through the old all-time highs, and it's just sitting under the old 2011 level at 465. So I don't know, it's looking bullish, but there's a big, massive tail on that breakout candle. So maybe it just spends a little bit of time consolidating in here. But you know, I wouldn't be betting against copper at this point. And then no prizes for guessing the other one. It's, of course, it's gold. It's the one everybody's been talking about. It was been hemmed in below that 2087 level for a long time, and then the old 2011 level at 1925 prior to that. But it finally had its day in the sun, and it's reached escape velocity, and off it goes. And again, that's gold would be another one that you wouldn't want to bet against at the moment. It's got a decent amount of momentum behind that move. So perhaps we just get a little retracement back to the 2087 level just to retest that level. That would be good if that happened. That might be an interesting place to get set for a long position. So just to summarize that, US stocks looking very bullish, sitting at their all-time highs, just starting to see the beginnings of a little bit of divergence here and there in some of the internals. Maybe that's just a sign that the momentum is starting to slow. Perhaps we get a pullback, perhaps we get some consolidation, but certainly not yet. The market still looks very, very strong at this point. The ASX 200s, we've broken out above the all-time highs, and we are sitting there above that 7,600 level. And again, if it can gather some steam at that level, then the path of least resistance looks higher for that market. On the currencies, sideways for most of the major ones. The yen is the exception. It continues to fall. And Bitcoin is doing the opposite. It's made a move from crypto winter back to its all-time highs, and once again looks set for higher to come. And on the commodities, the two superstars are gold and copper, and a little bit of weakness just showing up elsewhere. Before I let you go, here's a couple of strategies I'm trading at the moment, which are quite interesting. Monterey is a NASDAQ stock rotational system. As we saw, the NASDAQ itself up about 15%, and this one is up 34% already for this year. So I'm not unhappy with that outcome. And then my other mean revert, which I trade in tandem with it, is not done a lot this year, but it does very well in volatile times. Obviously, the market's been very quiet, so it's only had a few trades this year, but it's that 90% win rate still holding up. So smartsystematictrading.com if you want to get any more details on those. And with that, I will thank you very much for your attention. Wish you good luck, good trading. Bye for now.